Welcome to the lecture on venture capital and entrepreneurial finance. Venture capital will be abbreviated VC in this lecture. The plan is to give a brief overview of the industry. What is a venture capitalist? What do they do? Who are all the players in entrepreneurial finance? Then this course focuses on valuation. So we're going to think about different ways that VCs value an entrepreneurial firm. As you can imagine, a lot of these young companies, it could be a couple of folks working out of their garage, for example. That's the kind of entrepreneurial company that we're thinking about. It's going to be hard to value them quantitatively. We're just not going to have very much data, again, if it's HP starting out in the garage. So you need to have some way to value them. We'll talk first about qualitative valuation. What are the qualitative things that VCs are looking for when they're making an investment? And then we'll move on to quantitative valuation. We'll discuss something called the VC method. And the VC method is going to look a little bit different than what we've seen in the past. With APV, for example, we've been very careful about forecasting all of our cash flows out, making sure we have the correct discount rates and discounting the cash flows by the appropriate rate. The VC method is going to look a little bit different. It's going to look a little bit more ad hoc. However, we'll see that we can reconcile the two. We can reconcile the new method we learned today with what we've done in the past. After we've talked about valuation, we'll talk more broadly about what VCs are doing. How can they add value for investors? And part of that's going to be how they structure the deals. VCs write long-term sheets with entrepreneurial companies, with founders of companies. And a big part of that term sheet, a big part of the deal is to kind of solve problems, solve conflicts of interest problems between the investors and the founders, or to solve information problems between the entrepreneurs and the investors. Okay. So a brief overview of the industry. Venture capitalists will finance young companies with the prospect for high growth. It's almost always done with convertible preferred stock. So what this means is it's preferred stock, so the founder is on the hook to pay kind of fixed dividends to the VC. However, they never actually pay those dividends. Usually they don't end up paying those dividends. Usually the equity stock gets converted into common equity. That's the ideal situation, as the VC invests in convertible preferred, and if the company does well, they convert to common equity. But the VC always has the right to get the dividend if they don't convert. Usually the investments are not huge, right? It's like $10 million per round of financing. That's how much the VC will invest in the startup. VCs don't take control of the company. They generally take minority stakes. Now they will take board seats. They will, when they make these investments, they'll have a right to maybe 2 board seats out of 5. So effectively they'll have a veto. They'll have a veto vote on major decisions, but they don't want control of the company. VCs will also try to exit within 3 to 8 years. The ideal situation is through an IPO. You take a company starting in a guy's garage, you take it to the NASDAQ, and you sell a bunch of shares on the NASDAQ and make a lot of money that way. Or you could sell the stake. If the VC owns 25% of the company, down the line, that company could get acquired, and the acquirer would buy out the VC stake. Historically, this timeline has been stretched. So 3 to 8 years is kind of how the industry developed and what people think of it. But in recent years, it's been easier to stay private longer. And so in recent years, this timeline has been stretched out a bit. Before VC financing, there's other sources of financing that founders could go to, friends and family being one. Angel investors are kind of like VCs, but even more passive. So angel investors will invest less per round. They'll take less of a stake, and they'll also take less control of the company than a VC would. Or of course, banks. If you have a company that is kind of amenable to having collateral, you could go through bank financing. After some VC rounds, Like I said, the kind of quintessential exit would be an IPO, but you could sell the company as well, or you could sell to another private equity company. It could be even another venture capital fund. There's three main players in the venture capital industry. There's the entrepreneur who needs the money. Sometimes we call that the issuer, right? They're going to issue claims on their company. Then there's an investor. The investor's got the big pools of money. We think of these as like endowments, Harvard endowment, Yale endowment, pension funds. California Teachers Pension Fund is a big player. There's also sovereign wealth funds, other nonprofit foundations, corporations, banks, etc. They all have kind of pools of money that they're investing in various things. Some of what they invest in is venture capital. Venture capital is the intermediary between 1 and 2. Okay. The investors have the money, the entrepreneurs need the money. The investors give money to the VC firms. Basically, they own a stake in the VC firm, and then the VC will take that money and buy stakes in the entrepreneur. Okay, so they're in the middle. They're intermediating this big pot of money on one side to the founders and the projects on the other side. There's some technical words here. The VC is called a general partner. The actual investors, the pension funds and the sovereign wealth funds, those are called limited partners. They're limited. They're not the ones kind of making the investment decisions. The VC is making the investment decision. That's why they're called the general partner. Okay, so here's that statement in a picture. Right over here, we've got entrepreneurs who need money. We've got big investors on the other side. And then we've got VCs in the middle. So investors send money this way to the VCs. VCs choose which projects to invest over here. And then eventually, hopefully these entrepreneurs succeed. A lot of them won't, but hopefully they do. And then when the entrepreneurs succeed, then the VCs will cash out. And then you'll get a cash flow going from the entrepreneur to the VCs. And that's how the VC pays back their investors. Okay. So all the biggest companies today started like this, right? The Facebooks, Amazon, Apple's, Netflix, Google, Uber, right? All these big companies that make up such a large fraction of the S&P 500, they all started with VC financing. As we said, VCs are intermediaries. They make kind of small investments to begin with and want to exit quickly. A critical piece of this calculus is that VCs are looking for home runs. Again, they want to invest in a company with extremely high growth potential. A couple of PhD students with Google, for example, or a couple guys in the garage with HP, kind of a couple guys with an idea. You need a little bit of money to get the idea running. It takes off, it blows up, and then the VC can sell and make a lot of money that way. That's what they're looking for. More broadly, we've talked about kind of venture capital. These are the players in venture capital, but the picture looks the same with any kind of private equity. We've got these intermediaries in the middle. We've got investors on the left, big pools of money over here now. I flipped the picture, so instead of having investors on the right, now we've got the investors on the left. Big pools of money. VC funds are one type of intermediary that we're going to focus on, but there's lots of other types of financing vehicles. Angel investors, we talked about, they're kind of like VC funds, but they're more passive and they invest kind of lower amounts. We move up the scale, we go into bigger and bigger investments with like private equity and leveraged buyout funds, debt funds, etc. And then we've got issuers on the side. So these would be the startups for venture capital, or it could be kind of a distressed company if we're thinking about a distressed debt fund. In each case, we've got this intermediary trying to connect the investors to the issuers. Somewhat recently, there's been an increase in direct investments. So sometimes pension funds will take a direct stake in the issuers. That's more the case for private equity, less the case for venture capital, but this does happen sometimes. Okay, so there's three actors we've talked about. We've got the investors who have to choose which VCs to invest in. Here, there's a lot of different VCs out there. The investors have to choose which ones to buy securities with, the median VC is not very good. For most investors, they would be better off putting their money in, say, the S&P 500. Just buy a passive index fund, earn a return that way. That would outperform a lot of VCs. Now, the conventional wisdom is that the top quartile of funds do outperform the market, and they do outperform with persistence. So there's some funds that can reliably beat the S&P 500, and those are the funds investors are looking for. They want to put their money there to earn a higher return than what they could get with the market. Okay. Now, as a word of warning, everyone kind of knows this, and so everyone kind of cooks the books a little bit to say that they're a top quartile fund. Every VC wants to kind of present their numbers in a slightly different way to show that, oh, actually, we are a top quartile fund, right? So that's something to be careful with, but kind of broadly speaking, we know that the top funds do persistently outperform. We'll revisit this question later. Why are some funds able to beat the market? Why are some funds able to do better than the S&P 500? The punchline is some funds have to be able to improve the operations of the companies, of the issuers. The founder's company gets better because they worked with particular VCs. And we'll talk about the ways in which that could happen. But the point is, the VCs have to be actively improving their investments in order for them to beat the market. Right? If all the VC is doing is just spreading money around, taking kind of random bets, random stakes in companies, then they're not going to do very well. They have to do something else on the operational side to improve things. So that's one decision. The investor has to choose which VC to go with. Another part of this market is that the VC has to choose entrepreneurs, right? Which companies are worth investing in. That's going to be what we focus on today. We'll focus on how VCs value various entrepreneurial ventures, how they structure the deal to try to create value, and how they can increase the operational value of these entrepreneurial companies. And then the last question is from the issuer side, right? From the founder side, they have to think about what the VC is bringing to the table. If a founder is successful, they're going to have multiple offers. There could be maybe 2 VCs making separate offers to a given entrepreneur. The founder has to make the decision, well, what am I getting from each? The headline number could be the valuation, right? The VCs are offering different valuations for my company. But that's only a small part of what the founder has to think about. The founder has to really think about which VC is going to increase the value of my company, because that's going to make me rich, right? If one VC is giving me a higher valuation today, but then I don't grow as much in the future, then it's not as good a deal for me. Okay, so you can see very clearly here that you can get a whole class, a whole semester's worth of class plus in dealing with each of these decisions. We're going to focus on just number 2, but it's a very rich environment to think about. We talked about the intermediation, right? The VCs are in the middle. What are they trying to do big picture? Well, if we think about Modigliani and Miller, this is still corporate finance, and so everything in corporate finance stems back to Modigliani and Miller at some point. What did Modigliani and Miller say? They said that finance is irrelevant if the following assumptions were true. One, we said there's no taxes. Said that there's no information problems, no information asymmetries between investors and the firm management. Also said that there's no conflicts of interest between the investors and firm management. And then we had a bunch of other assumptions that aren't going to be the focus of today. Things like no bankruptcy, no cost of bankruptcy. We need to have efficient prices. Prices reflect all the information that's out there. And we also needed that investors could trade on the same terms as the company. They could borrow money on the same terms, etc. here's our list of M&M assumptions. We said that for finance to matter, it has to be because one of these assumptions is violated. And what the financial industry is trying to do is to move things closer to the M&M ideal. Right? By moving things closer to this perfect M&M world, finance can create value. What intermediation is doing, what the VCs are trying to do, is fix problems 2 and 3. Problem 2 is about finding good deals. Okay, so with information asymmetries, we know that entrepreneurs know a lot more about their company than investors. That becomes a problem. Like that means the M&M world is not going to hold, and now there's room for some value from finance. The VC is going to be doing research to try to figure out which deals are good, which entrepreneurial companies have promising projects. Likewise, the entrepreneur has very different incentives than investors. Okay, so that's point 3 here. There's no conflicts of interest. Well, there are going to be conflicts of interest between the entrepreneurs and the investors. What the VC is going to do, once you find the good projects, you also want to make sure the incentives are aligned. Entrepreneurs often talk about their firm as if it's their baby, right? They get very attached to it. They identify with it. It's part of their kind of their persona. Investors, on the other hand, mostly want to earn a return. And so they don't necessarily care about this kind of psychological connection that founders have with the company. Investors want to get a return. A VC is going to try to align these things. A VC is trying to make everyone work toward the same end. Try to align incentives so that the entrepreneur also wants to make money with the investors. So we're going to try to resolve these M&M problems. A couple ways that VCs are going to do this is with pre-investment due diligence. Okay, so that's this first part. They're trying to reduce these information problems with due diligence. They're going to do research on the company and on the industry. Now, part of this research is going to look like consulting for the entrepreneur. What the VC is going to want to do is advise the entrepreneur. Even before the VC invests, the VC is going to want to kind of get a look under the hood, right? Well, the easiest way to do that is to offer some consulting to the entrepreneur, try to advise them on the industry and what they should do. They'll do that for free, free in quotes, because what the VC is getting out of it is information. And the VC is trying to resolve this problem. Okay. And then with post-investment monitoring, we talked that the main way that VCs are going to do this is they'll have board seats, for example. So the VC can have a veto on what the company wants to do. If the company wants to do something that kind of destroys value for the investors, the VC can veto that. And again, that's trying to get at these conflicts of interest. That's one way that they can get at these conflicts of interest here. With intermediation, you don't want everyone doing it. Right? You don't want all of the investors, all the pension funds in the world trying to address these two problems for every entrepreneurial venture that's out there. So what the investors do is they kind of outsource this to a VC. They trust the VC to do it. They pay a VC to do it. So it's costly for the investors because you have to pay the VC for all of their work and skill. But that's better than everyone trying to do it for themselves. That's a big picture view of the industry. Next, I want to talk about how VCs can value these companies qualitatively. They're not going to have a lot of data, but they still have some kind of systematic ways to think about the companies. Valuing these companies is not going to be a science. You're not going to have a cookbook that you can use to value an entrepreneurial company. But there are certain factors that VCs seem to look for. There's a checklist, if you will. It's definitely more of an art than a science, but there are some common threads that VCs look for. I should also mention that this qualitative analysis is going to be more important early on, right? You're just not going to have the numbers to do a kind of hard quantitative analysis, so you need something. Steve Kaplan is a finance professor at the University of Chicago, and he coined an acronym called outside impacts. What he did is he worked with a lot of VC firms, and with these VC firms, what they'll do is the associates and the partners will write memos to each other. They'll have lots of different investment opportunities, and they'll write memos to each other trying to, within a given VC firm, the associates within that firm will write memos trying to talk about why one firm would be a good investment or not. And so he was able to read and code these investments for 10 different VC firms, all these internal memos, these discussions on 80 investments, and he was looking for some kind of a pattern. And this outside impacts acronym is what he came up with. So we'll talk about each in detail here. We'll start with impacts. Okay. Is this going to be a positive NPV opportunity? What is impacts getting at? You want to know whether the company can grow fast enough to get to an IPO in 5 or 10 years, right? We need a lot of growth. How can you get that growth? Well, each of these pieces, the impacts pieces, are a part of that. You need each one of these in order to sustain that type of growth. They'll talk about the idea of the industry. Then they'll talk about how big the market is. Right? You need to have a large market to grow into. It can't just be some little niche that you're trying to take over. Right? The scope has to be very big. Right? Ride sharing with Uber. Right? Everyone uses taxis. Uber can take over that market. That's a huge market. Right? That's M. Okay. How big is the market? It needs to be big. Second is P, the value proposition. Right? There has to be something different about the company. Right? Again, with Uber, it's not just a taxi company. Now you're doing it on your phone. It's very convenient. You don't have to think about it, and you can do it anywhere in the world. And you're also getting access to a whole labor pool of drivers who, before they didn't have that ability to work like this before, but now they do. Okay, so there has to be something kind of uniquely different about it that sets it above and beyond what's out there. Okay, that's P. That's the value proposition. If you don't have that value proposition, it doesn't matter how big the market is, you're not going to get a big piece of the market. Right? You need the market to be big, and you need to be able to take a big chunk of the market. That's M and P. Then there's A. That's acceptance. Okay, so even if you have a big market, and even if you're doing something different, customers need to really want it. If we think about Uber again, customers really wanted it. It was just a kind of a brilliant idea to have the convenience to order a taxi on your phone, and also the drivers really wanted it. It was a great way to make money kind of in your spare time. So you need to have this urgency. You need to have a big market where you're doing something different, and customers need to really want what you're doing. That's how you can capture this big market. The next piece is competition. You need to have protection from competition. even if you have these first three, you've got a big market, you're doing something different, customers really like it, they want to kind of throw their money at you, right? Customers want to be able to throw their money at you. Even if all of that's true, it's not going to be worth anything if your idea can just be copied. So the warning here would be something like Groupon. This is the example I always use. Groupon was getting very big after I finished school. What's the business model for Groupon? They would work with various businesses to set up special deals. And then they would send out coupons to everyone who signed up. So they would just kind of send out these really nice coupons every week or something like that. So, well, everyone would sign up for Groupon because they liked getting these great deals in their inbox. And local businesses liked to sign up because they would get great exposure, right? Everyone was signed up to the Groupon listserv. Businesses could get word out about their products far and wide. And then Groupon would get a cut of that. Right? Groupon would get some fraction of all of these redeemed coupons. Okay, so it was a very good idea. It was a very big market. It grew very fast. It was different. No one had done that before, so it's a satisfied proposition. Everyone wanted to do it. Everyone was signing up. The problem was it was very easy to copy. Within a few years, there were 4 or 5 different companies that were also just sending out emails. Right? All you need to do is work with a business and then send out emails to people, set up some kind of listserv. That's not hard to do, and so everyone did it. Groupon then, they grew very fast, but then they kind of petered out. You need some kind of protection from competition. What are some ways that a company can protect itself from an entry coming in and just copying the deal, copying the idea? Sometimes students will say that, well, once you grow, you can buy out competitors. Every year, that's always something somebody suggests. If you get in there first, you can always just buy out all of these folks who are copying you. There's a problem with that. If it's easy to copy your idea, you have to keep buying out competitors, right? You buy out the first competitor who copied your idea. Okay, then a second competitor comes in, try to buy them out, right? The third competitor comes in, and you're just kind of perpetually buying out these copycats. And that's not very sustainable. The other issue here is that the whole point is to try to not give competitors your money, right? When a competitor comes in, they're trying to kind of take your cash flows, essentially. They're trying to take your customers, take your cash flows. You want to prevent that from happening. Well, you don't want to just write them a check, right? That's essentially what you're doing when you're buying out your competitors, is instead of having them fight for your customers and have the customers give them money, you're just giving the money to them directly, right? So this isn't a very, this isn't a good way to protect your business, right? You're not going to survive long if this is what you're trying to do. What are some things that you're looking for if you're a VC and you're trying to think about companies that can sustain this growth and won't be copied? You need some kind of barrier to entry. You need it to be hard for copycats to come in. Some types of barriers here would be a patent, for example. With a patent, you have a legally enforceable barrier. No one else can do what you're doing unless they get your permission and they pay you whatever you demand. So this is important for like pharmaceuticals. It's not used. It's used some in tech, but but it's definitely important for pharmaceuticals. It's great if you have it, but it's kind of industry specific whether a patent will prevent copycats. The other big kind of in Silicon Valley now, so if patents are particularly big with pharmaceutical companies and medical devices, things like that, it's not used very much in like social networking, for example. Facebook, Snapchat, they don't have patents. You can copy these things. Twitter, people copy Twitter. There's various competitors to it. Yet these social networking sites are able to fend off competition. People may get really mad at Facebook, but they don't go off and start Bookface. Right? You could probably copy any of these websites pretty easily. Right? Snapchat is just an app that deletes your photos. Right? I think people could reproduce that quickly. So why doesn't someone do that? Why doesn't an entrepreneur come in, start Bookface, make billions of dollars, and take revenue from Facebook? With these social network companies, they all have what's called network effects. As the name suggests, with social networks. The idea is that everyone is using the same thing, right? Everyone's on Facebook. So if you want to create a competitor, that competitor isn't going to be worth very much unless everyone else is using the competitor, right? So you need people to switch from one to the other, and that's very hard to do. Even if you can completely duplicate the website isn't valuable unless you can also get the users there. An interesting experiment here will be with TikTok going forward. Okay, so TikTok's kind of the latest social media app. You all know more about it than I do. They're trying to enter into the US, and there's all sorts of regulatory issues with that. They're trying to get a buyer. So Microsoft, for example, is thinking about buying TikTok. Facebook is taking a different approach. Facebook is trying to buy the network. Forget about the app. The app you can reproduce. Facebook is trying to get the network of people and buy them and move them to Facebook's preferred alternative. How is Facebook trying to do this? Well, there's all of these kind of content producers, all the people who are making the spazzy 10-second videos. Facebook is trying to pay them so that they don't use TikTok anymore, but they use Facebook's app. I forget what it's called, but the point is they're trying to move the producers from TikTok to their own preferred site. Okay, they're trying to move the network to where they want it to be and kind of get this gratuitous, this kind of virtuous cycle here with these network effects. That's an interesting experiment. I'm not sure if anyone has done that successfully, trying to just buy the network itself. People have bought the apps. There's been changes in ownership for Snapchat, for example, or kind of Periscope, other companies like this. I'm not sure if anyone has tried to just pay the creators themselves and then move the network. So this will be a very interesting experiment to see if TikTok's network effect can stay valuable, or if it can be kind of undermined like this, Facebook going directly to the producers. Okay. So every new social media company is trying to say that they have network effects, trying to protect themselves. What are some other barriers of entry? Well, more kind of old school Econ 101. would be economies of scale. The idea here is that your costs drop as you produce more. This creates a first mover advantage. If you're the first one into a market, you ramp up your production, that allows you to cut your costs. If anyone else tries to move in, they're going to have to pay higher costs than you. You can always kind of undercut them on costs because of these economies of scale. The incumbent can undercut on price. An interesting idea in the kind of more data centric, in the online centric world that we're inhabiting now, is that data can provide an economy of scale. If you think about Amazon or Google or Apple, they all have so much more data now. They've got to suck up all the data that they can about us. They know exactly kind of what we want and what we're willing to pay for stuff. So if an entrant were to come in and try to compete, they would have to be feeling in the dark, essentially. They'd have to try to feel what works would be much slower than these other companies that already have a lot of data at their disposal. And to make things even kind of more stark, is a lot of startups will try to we'll try to use Amazon, for example, to sell their product. They kind of guess, maybe this is a good product. We're going to put it on Amazon, see if it sells. Well, Amazon sees all of that, right? So Amazon collects all the data on what's selling very well, and then Amazon can create a competitor product based on that data. Okay, so that's kind of a new take on what is an economy of scale, right? It's easier to find opportunities if you're already collecting all of the data. Okay, so that's kind of big picture what VCs are doing here. They're trying to find some protection from competition. Otherwise, it's not going to be a sustainable, you're not going to be able, you may be able to capture the market very quickly. You may be able to capture a lot of money very quickly if M, P, and A are true, but someone else is just going to come along and take it away. So you need to have some protection there. T is for timing. Is it a good time for this idea? Another interesting idea that's been floated recently is that if you think about the tech bubble in 2000, one idea is that there were a lot of good ideas in the tech bubble. They were just 20 years too early. So you think about grocery delivery. Well, there were startup companies in the late 90s, early 2000s that focused on delivering groceries. There just wasn't quite the infrastructure there to support it. There wasn't quite the internet infrastructure in place to support that. But now 20 years later, you go forward and you've got things like DoorDash and other delivery companies that are doing exactly that. Okay, so this timing can be an issue, even if it's a great idea. If it's just a little bit too early, 20 years too early, then it's not going to be sustainable. And finally, speed. So how quickly can the idea be implemented, right? You want to grow very quickly. So even if you have a big market, customers want to kind of throw money at you, and protection from competition, and it's right timing, it has to be something that can be done reasonably quickly in order to take advantage of those benefits. So to summarize, with impacts, we're trying to get this extremely fast growth. The rest of outside is focused more on implementation. If you have an idea that could grow very quickly, could be a home run, how are you going to execute? There's obviously going to be lots of uncertainties in any of these entrepreneurial ventures. Are they going to be manageable? There may be issues with the team. Do you have all the right members in place? Are you missing someone? Are you missing, a finance person? Are you missing a tech person? Can that be fixed? Again, that's implementation. How about the strategy? What is that consistent with fast growth? Are you taking the right steps so that you can grow as quickly as you need? I is for investment requirements. So how much cash do you need today? Right? How much are you going to need over the next 5 or 10 years? What's the right way to give you that cash? Should you stage it? So with a stageable investment, for example, you would give a little bit of money today, and then the VC would come back in a couple of years, say, provide a bigger investment, then maybe a couple of years later, provide another investment. Right? There's pros and cons of doing that. What's the appropriate course of action? That's I. D is for the deal. So the VC is going to come back with a big long-term sheet, lots of different features of that, lots of different contractual pieces. Can you manage the uncertainties and provide incentives in that contract? Okay, so again, it's about implementing the deal. And then exit. How are you going to exit the investment? That's always got to be on the mind, right? If you grow very quick, you need to have some way to cash out later on. Could you go through an IPO, right? Is the founder going to be okay with that? Could you sell to another company? Again, is the founder going to be okay with that, selling to another company? So these are all things that the VCs are thinking through qualitatively when they're making these investments. So to summarize, the VC wants to exit quickly. That's going to require very fast growth. The impacts acronym is one way to capture all of those features that you need in order to sustain the growth. And then outside is mostly about implementing all of those, implementing that strategy. Now I want to turn toward quantitative valuation. How do VCs actually create pro formas? What do those look like, and how do the numbers look? I'll introduce what's called the venture capital method. This is how VCs come to a quantitative valuation for a company and decide how to negotiate with the company. How much is the company worth? How am I going to negotiate my investment in the company? We're going to compare that to what we've done in the past, the discounted cash flow model and the APV, adjusted present value method. The venture capital method is going to look different on a couple important dimensions, and so we want to be able to reconcile the two. Everything we've done in the past is still true. Everything about discounting cash flows that we've seen is still just economically true and valid. So we need to kind of think through the VC method to see how to reconcile the two. Okay. And clearly, we're not allowed to use WACC. These companies are too volatile. The key assumption with the weighted average cost of capital is that there was some stability. That's obviously not going to be the case here. So we can't do anything along that line. These are the steps for the venture capital method. There's only 2 cash flows. The first is the amount that they're investing in the company, right? The VC is going to put some money into the startup. The second cash flow is at exit. That's step 2. What is the exit value? The VC isn't going to be extracting cash flows kind of in the middle, right? You just have 2 kind of bookend cash flows. You invest, and then you extract your investment at the end. You're not going to be pulling cash out in the middle. That's obviously different than what we've done in the past. In the past, we have an entire stream of cash flows, and we have to value all of them. Here, we just have 2 cash flows. The reason is that when you invest in an entrepreneurial company, you can't really pull the cash out. It's not easy to sell stuff or to pay dividends to the equity holders. The only time that the VC can really cash out is when they sell their stake. When do they sell their stake? It's usually through an IPO. That's the best case scenario. Or if they sell their stake to, say, another company. If Google buys the startup, they incorporate it into Google's operations, then the VC would get paid by Google in that case if there's a strategic buyer. Generally, they will value this exit price based on some multiple, possibly a growth model. Okay, so you just have one terminal value essentially. That's how the VC is going to value the company. That's what determines the VC's cash flow when they sell their stake. Step 3 is then simply to discount this terminal value, discount this exit using some target rate of return. Once you have that, you have the value of the company. You compare that to your investment amount to determine your required percent ownership. Okay, so the VC is going to put in some amount of money. Steps 2 and 3 value the company. Step 4 is going to compare the value of the company with how much the VC puts in. If the company's worth 100 and I put in 10, then I should get 10% of the ownership. Let's just do an example, make sure that we're all on the same page here. The VC is thinking about investing $4 million into a company. Right, so that's step 1. What is the amount invested? Then you do the forecast. In 5 years, the VC forecasts that the company will have an EBIT of 10 million. We have a multiple, an EBIT multiple here. Comparable companies have an enterprise value over EBIT of 15. Okay, so we can put these 2 bullet points together to figure out what the company is going to be worth in 5 years. There are some intermediate cash flows. Okay, there's no cash flows between years 1 and 3. There is some cash in years 4 and 5. This is $5 million in excess cash that the VC doesn't, or that the entrepreneurial company doesn't need for their operations. They generate $5 million in cash, and then it's not put back into the operations. However, no money is distributed before year 5. Okay, so even though the company is generating excess cash flows in years 4 and 5, nothing gets paid out until year 5. They're not paying out any dividends until this exit point at 5 years. The company won't require any more equity investments. There's not going to be any debt. Okay, the VC has a hurdle rate of 50%. 2 questions. How much is the company worth, given all that information? And 2, what ownership stake will the VC require in order to make that $4 million initial investment? Okay, so let's set up the numbers here. I have a little table. We've got a timeline going from today to year 5. Everything's done by year 5 according to these forecasts for the VC. Nothing is generated by the firm up until year 4. Okay, so nothing's in year 1 through 3. You get $5 million in year 4 and $5 million in year 5. Okay. But then there's also the terminal value, right? We still need to figure out the terminal value in addition to these cash flows in year 4 and 5. Recall that the terminal value is an enterprise value, but it's an enterprise value at time 5. It's how much the company is worth, how much the operations are worth at year 5. We have the enterprise value over EBIT multiple of 15. That's in this 3rd bullet point. We also know the EBIT at time 5 for this company. So we're going to solve for the enterprise value at time 5. The enterprise value at time 5 divided by the EBIT at time 5 should be 15. The EBIT at time 5 is given as 10 million. That's going to give us the terminal value. The enterprise value at time 5 should be 150 million. The terminal value then is the value of the company. So we have 150 that the VC can sell the company for at time 5. What's happening with the VC? Well, the VC today is going to put in 4 million. Okay, that's the first bullet point, minus 4. And now they can't get any cash flow until time 5. Until they exit the company, they're not going to get anything. They're going to get some share of those cash flows, of the $160 that the firm has generated. 5 in year 4, 5 in year 5, and then the terminal value of 150. So they're going to get some fraction of that. Let's call that X. We don't know how much that's going to be, but there's some fraction x that they're going to get at time 5. So back to this question, how much is the company worth? If these are the cash flows, how much is the company worth to the VC? Well, the only cash flow we have to deal with is that 160. That's how much the company is going to pay out in year 5. We're going to discount that by our hurdle rate of 50%. That occurs 5 years into the future. So that's going to give us a present value of about 21.1 million. And again, the only cash flow the VC is thinking about is that exit amount. Okay, and any cash flow that gets generated before then just gets pushed to the exit. So we get everything at time 5. So that's how the VC would value the company, it'd be 21.1. So what would be the required ownership stake for the VC? If the VC is going to put in 4 million today, then it has to be the case that they get compensated for that 4 million at time 5. They get some fraction of this 160. That fraction has to be worth $4 million. The investment is 4 million. That has to equal their share in the company. The logic is very simple. If I put 4 million in, I better get out something that's also worth 4 million. So we have the investment amount is equal to the VC's share multiplied by the value of the company. Well, the value of the company is this 21.1. So now we can solve for the VC share. How much does the VC require? It's going to be the investment amount divided by the value of the company. So just I divided by V for short. So we have 4 out of that 21.1. It's going to give us about 19%. The VC requires a 19% ownership stake in order to put in the required $4 million investment. Okay, so those are our steps, right? What is the amount invested? 4 million. What is the exit value? That's 160. That's how much the total company is going to be worth when the VC can cash out. We discounted that. That's step 3. We discount that 160 using our target rate of return of 50%. That gives us the total value of the company is 21.1. And then finally, we compare that 21.1 to the investment amount of 4 to give us the required ownership. We haven't talked about this hurdle rate. We're going to talk about this 50% a lot more, right? This is a crazy high discount rate. We've never seen anything like that up till now. There's some interesting subtle economics that drives that 50%, but in the back of our head, it should be weird, right? You should be thinking about this. It should look a little bit odd to us. It's also a little bit odd that the only cash flow occurs at the exit, right? That's new to us. So these are the two kind of key features that we've seen so far that's different than APV. We get just one cash flow at exit, and then we have a super high discount rate. These are some kind of sample hurdle rates that VCs use. It depends on the stage of the company. So seed and startup stage, those are very early on, before VC financing even. First stage, that's the first round of VC financing. Second stage is the second round. And then these later stages are kind of more mature companies. And even down here, turnarounds, these are companies that are kind of in distress and you need to restructure things. The second column gives the rate of return, the annualized rate of return for each of these investments. So for seed and startup, you see 50 to 100%. For first stage and second stage, we're seeing 30 to 60%. Again, these are kind of crazy high. We would never expect to get these cash flows, these hurdle rates unless we're dealing with a company like an entrepreneurial firm. This last column has the holding period for a given investment. So if you're getting in very early, you're going to be holding the company for more than 10 years. For first stage, second stage companies, it's going to be more like 5 to 10 years before you can finally cash out. So the example we did here, that would be on the, that would be kind of a quicker holding. 5 years is on the short side of an investment horizon. There's some important terms to know. Post-money valuation and pre-money valuation. So the post-money valuation, that would be the value of the company after you invest. So for this company, the VC is valuing it at 21.1. That would be the post-money valuation. The pre-money valuation is simply the value of the company minus the investment amount. So in this case, you put in the company's worth 21.1. That's after you put 4 million into the company. So the pre-money would be 21 minus the 4 that you put in. Okay. So these terms show up sometimes. I want to make sure that you've seen them at least once before. It's not super important for us, but in the world of entrepreneurial finance, you'll see these things. To relate these terms to what we've seen in the past, if the VC invests $4 million for 19% of the company, then you can figure out the value of the company. Okay, so that's what we did here. We have a required share of 19% for $4 million. Well, you can use those two numbers to back out the 21 million. With the VC method, we were calculating the required ownership share, but we can go in the opposite direction if we have the other two data points. You can find the valuation of the company by dividing the investment amount by the ownership share. So this investment amount of 4 million, you see that the VC put 4 million in and got 19% of the company. Well, that works out to be $21 million for post-money. That's what we calculated up here. Then the pre-money would simply be the post-money minus the investment amount. So 21 minus 4, that would be 17 million. Next, I want to reconcile the VC method with what we've seen in the past with APV. And in particular, I'm going to focus a lot on this hurdle rate of 50%. Okay. If we can make sense of those very high hurdle rates, then we can reconcile the VC method with the more traditional APV approach. Another way to state the puzzle is in terms of betas. If we think about this 50% hurdle rate that VCs are using, think back to our discussion of risk and return. Right? We spent a ton of time drilling in this idea that only systematic risk matters. All the idiosyncratic risk is irrelevant. The only thing that investors care about, the only thing that earns a return, is systematic risk. We measure this using beta. So how much systematic risk would you need to justify a 50% hurdle rate? We can go back to our CAPM formula. Right? The return on some investment I is going to be the risk-free rate plus the beta of asset I times the market risk premium. So if we have a 50% return on asset I, suppose we have a risk-free rate of like 4%. It's probably a little bit high, so suppose we have that. And then we have a market risk premium of, say, 8%. Again, that's a little bit high, but just to be conservative, we can estimate what would be the lowest beta that could justify a 50% return. If you solve for this, you'll get a beta of almost 6. In order to justify a 50% return, the beta would need to be about 6. So for a 10% move in the stock market, it's kind of what happens on average in a year. If the stock market moves 10%, then you would expect these assets to move up like 60%. Okay, so just phenomenally high returns here. Does that make sense? So we haven't seen anything with a beta of 6 so far. If you think about all of these startup companies, if you think about, you know, Facebook or Google, all the companies that were financed by VCs, it's going to be very, very hard to get a beta of 6, even when they were in early stage. Especially when you consider the entire universe. You know, if you think about successes and failures, put them together, it's going to be very, very hard to get a beta close to 6. In fact, when academics do this, they estimate a beta closer to 2. Okay. So these entrepreneurial firms are risky. There's no doubt about that. But they're not systematically that risky. Not enough to justify a 50% hurdle rate. Okay. At best, we can get maybe 20%. With a 4% risk-free rate, a beta of 2. That's kind of the highest that we can estimate for a beta for these entrepreneurial companies. Market risk premium of 8. Again, these are all on the high side. That's going to give us at most a 20% required return, nowhere near the 50% hurdle rate that people are using. So what could be some other explanation? Well, VCs get paid, right? VCs get fees. Remember, VCs are doing a lot of work. We talked about all the things that they're doing up here. They're doing due diligence. They're doing post-investment monitoring. Right? They have to get paid for that. They're getting paid in terms of returns. When the investments do well, when the entrepreneurial companies do well, VCs get paid out of that. Okay. So if you account for that, we can think through that process. We said that the pension funds, right, the institutional investors, they require about a 20% return to compensate them for the systematic risk that they're taking. Now, they have to get that 20% after they pay the VCs. So how are VCs paid? Well, they're paid 2% of assets. So if the investor gives $100 to a VC, the VC gets $2 every year. And then VCs also get 20% of the profit. So if you do a little bit of algebra, you can figure out that in order for investors to earn 20% per year, the actual assets have to earn 26%. Okay. The startups have to earn 26% per year. That's going to be enough to pay the VCs their fees, this 2% fee on the assets and 20% fee on profit, and have 20% left over to give to the investors to compensate them for their systematic risk. Okay, so we've thought of a couple different explanations. The highest we can get, the highest discount rate we can get for startups is like 26%. So we're still a far way off from the 50% that VCs actually use. How can we kind of put this put this to bed? How can we solve the puzzle? The key is that VCs will invest in companies that fail very frequently. So when we talk about this 26% return, that's like an expected return. That's what we would expect to get. Remember when we used a CAPM, this is an expected return I based on the beta of asset I. The 26% is the expected return that we need to earn. The 50% that VCs use, that's like a best case outcome. Okay, so instead of discounting expected cash flows by an expected return, what we're going to be doing is discounting very high cash flows by very high hurdle rate. Okay. The key is that when VCs make their forecast, the forecast is a best case outcome. Startups are going to fail with a very high probability. The VC doesn't forecast those failures. The VC isn't going to bother spending their time thinking about all the different ways that a startup can fail. Instead, what the VC is going to do is forecast what could happen. What's the upside, right? If everything goes well and we get this home run, how much will a company be worth? That's what the VC is forecasting. It's going to be easier for the VC to do this, right? The VC doesn't want to spend a lot of time thinking about all the ways that a company can fail. Rather, they forecast the home runs where everything works out well. Excuse me. Now, the problem is if the cash flows are best case outcomes, then they also need to use kind of a best case return. So instead of discounting expected cash flows by expected returns, the VCs are forecasting best case scenarios. So therefore, the discount rate that they use needs to be like a best case return. That's how we can rationalize a 50% discount rate. The cash flows aren't an expected cash flow. The cash flows are the best case cash flow. We have to discount that with a very high discount rate to reflect the high probability of failure. There's a high probability that the startups are not going to give anything back to the VC. How do you account for that? You ramp up the discount rate. We've seen this before when we talked about bonds. What's the best case cash flow for a bond? Well, if the bond pays off all of its promised cash flows, that's the best you can do. If it doesn't default, that's the best that you're going to do. We said that the yield to maturity is the best case return, and it's the return you get if the bond pays the best case cash flows. If the bond pays all of the promised cash flows, the return will be the yield to maturity. So we had the best case cash flows, we discounted them by the best case discount rate, the yield to maturity, to get the price of the bond. We saw that that was equivalent to discounting what you expect to happen, the expected cash flows by the expected return. You get the same answer. Okay. Same exact logic here. Instead of discounting what we expect to happen for the startups by the expected return, we're discounting a best case scenario by the best case return. Thinking through this logic, we're going to be able to calculate the probability that a company fails, and that's a useful parameter to know. When a founder is negotiating with a VC, what they can do is they can look at the VC's valuation and kind of figure out what's the implied probability that my company is going to succeed. And if that probability is kind of too low, if I think that my probability is higher, then I can push back on the VC and I can hone in on that parameter to try to get a higher valuation. So we're going to do a simple example to see what that would look like. So consider a company, new company, started in 2016. The VC is thinking about investing 31 million into the company. I is 31. After they make this investment, they're projecting sales at year 5 will be 204. Okay, so remember, the VC doesn't care about any intermediate cash flows, they just care about exit. So we're only forecasting that one sales figure. And they're going to use a exit multiple of 2 times sales. So the exit value of this company is going to be 2 times 204, which is 408. That's our terminal value. That's what it's going to be worth when the VC sells their stake. To keep things simple, there's no intermediate cash flows, there's no debt or excess cash. With a beta of 2 and taking into account the VC's fees, we get a discount rate of 25%. Okay, so that 25%, that includes, that incorporates systematic risk of the investment. The beta is 2, and it also incorporates fees. It does not incorporate the probability of failure. That's like our APV discount rate. This would be something that would be familiar to us in an earlier lecture. We're going to value this company using the APV method, using this kind of reasonable discount rate of 25%. And then we're going to switch to the VC method. We're going to value the company using a very high hurdle rate of 50%. We're going to be able to compare those 2 valuations to get the probability of failure. And as I said, that's a useful parameter to know. What's the APV valuation here? What's the post-money APV valuation? For the VC, there's only one cash flow. There's only this 408 exit value. That occurs at time 5. And so then we're going to discount that 5 times. We're going to discount it by a kind of typical APV hurdle rate of 25%. So we have a 408 value at exit. We have a 25% APV discount rate. That's going to give us a present value for the company of about 134. To review the definitions here, if that's the post-money valuation, we can find the pre-money valuation as post-money minus the investment amount. So we invested 31 into the company, had a post-money valuation of 134. So that means the pre-money valuation is 103. Just in case you see those terms. Moving on to the next question. We want to use the VC method to value the company. This hurdle rate of 50%, that incorporates the systematic risk of the investment, and it incorporates the VC fees, and it incorporates the probability of failure. The VC is not a dummy. The VC knows that there's a very distinct chance that this company won't survive. That's why they ramped up the discount rate to 50% instead of 25%. We're going to do the same exact valuation. We still have the same cash flow at time 5. Now we're going to use a different rate. We're going to use a VC rate. That's going to give us a valuation of about 54. This is how much the VC is actually valuing the company at, 54. And again, you can do the pre-money valuation. If you know the post-money, it's going to be 54 minus the 31 investment. So we're going to get a pre-money of 23. Okay. The final question is asking to find the probability of failure. We're going to be able to back out the probability of failure by using the APV valuation and the VC valuation. We compare the two to give us a probability of failure. The way to think about this, to spell this out, we want this probability of, we'll solve for the probability of success first. It's a little bit easier to do that. Okay. Probability that the company actually succeeds, we're going to multiply that by the value of the company if it succeeds. You put those two things together, that's going to give us kind of the expected value of the company. There's only some chance that it's going to succeed. If it succeeds, we're going to get a valuation there. We multiply the probability that it succeeds times the value of the company if it succeeds. That gives us kind of the expected value. What is the value of the company if it succeeds? Well, that's this 134. That's the APV valuation. Remember that the 25% discount rate here did not include the probability of failure. So when we used it, we were pretending that we expected it to succeed. We're pretending that this is what we expect to happen. We're expecting that 408 when we use a reasonable 25% discount rate. That's the value of the company. If it succeeds, it's at 134. Now the VC is not doing any pretending. The VC knows that they need to make money. They're not going to give any money to the founder if they don't have to. So this valuation of 54, that incorporates that probability of failure. So this is the expected value. This is how much we think that the company is actually worth, is 54. Putting those two things together, we can find the probability of success as 54 divided by 134, which is about 40%. So now we have a parameter. We have a number. We've honed in on it. We think that the company's going to survive 40% of the time. The other 60% of the time, they're going to fail, and the VC is not going to get anything out of it. This is all spelled out in the slides here. We get a 40% probability of survival. It's helpful to get this explicit probability. If you're negotiating with the VC, you can negotiate on that term. You can say, does this make sense? Is the probability of actually making it higher than 40%? If the VC is kind of lowballing me with an offer, then this probability of success is going to be too low. And I should push back and say, this probability is too low. You should give me a higher valuation to reflect my actual chance of success. It also lets you calculate the value of the company under different assumptions. So if your probability of success is really like 20%, then you can figure out what the valuation should be under that outcome. This probability is also pretty stable over time, so we can see that in this next table. This table is showing the value multiple for VC investments. So if a VC puts $1 into a company, how much are they getting back? We have all the different outcomes here, the entire distribution of outcomes. So down here, if you put in $1, the VC gets over $100 back on that investment. How often does that happen? Well, it would happen 0.2% of the time for first round investments. First round just means this is the first time that VCs have invested in the company. It happens, 0% of the time for second round investments or third round investments, the second time a VC invests or a third time the VC invests. Okay. We look at how often do VC investments get nothing back. You put $1 into a company. How often do you get $0 out of it? About half the time. For first round investments, it's 49% of the time VCs get no money back, 46% for second round, 44% for third round. So this is what I mean by it's pretty stable. Okay. How often do VCs get less than a quarter back? Less than 25 cents per dollar, 10 to 13%. We can sum up all the probabilities less than 1 to get a probability of failure. You put in $1, how often do the VCs get less than $1 back from the startups? About 74% of the time they lose money on their investments, and a lot of that time they're getting 0 back. They're losing just the entire thing. Okay, so it's a pretty stable probability. What the VCs are shooting for, obviously, is these home runs. 6% of the time, those first round investments are multiplying the investment by 10 times over. You put in $1, you get over $10 back 6% of the time. For second and third round funds, those home run frequencies go down. You have to pay a higher price if you're not the first VC into a company. You pay a higher price, your returns are smaller, but still 3 to 2% of the time you're getting 10 times your money back. But just kind of glancing at this table, you see there's huge probabilities of failure. And that's why the VCs need to use these very high hurdle rates. How do we get this P? Well, we just inferred it here. More generally, you can look at industry data. That's what we saw on this previous slide. We see exactly how often companies are not giving anything back to VCs. You can also infer them from term sheets. Okay, so a term sheet, that's a contract that the VC writes with the startup. The headline number for these term sheets is a valuation. The VC is promising to put in so much money, and in exchange, they get a share of the company. You can put those two things together to figure out the implied valuation of the company, and then use that implied valuation, compare that to your APV valuation to get the probability of failure, just like we were doing here. So let's do a little example of that. Using some of the same numbers that we had before, suppose that you put in $31 million from a VC, and the VC demands an 81.6% share of the company. What would be the implied valuation from that? We saw this formula before for post-money valuation. You have the valuation of the company multiplied by the stake that the VC gets. That's got to equal the amount that the VC is putting in, right? The VC has to get something of equal worth when they invest. So if you see the investment amount of 31, and you see that they're getting an 81.6% share, and that means that the implied valuation of the company is 38 million. We compare this to what you could get using a APV valuation. We did this up here. We got 134. Right? APV valuation, we're just discounting our exits by a APV hurdle rate. That's not including the failure probability, so it's only including systematic risk and fees. That's how we got 25%. The valuation ended up at 134. This gives us the probability of success. It's going to be the 38 that the VC is actually valuing the company at, divided by the 134 that we get if we ignored any kind of failure probability. That's going to give us a probability of about 28%. And again, the logic here is we have a probability multiplied by the value if it succeeds. If it doesn't succeed, then the value is just going to be 0. you multiply the probability that it succeeds times the value if it succeeds. That gives you the expected value. The VC is giving this 38 as the expected value for the company. The 134 was the value if it succeeds. So the implied probability of success is 28%. So to summarize, we're wrapping up the quantitative portion of this lecture. We know that VC valuation just looks a little bit different than what we've seen in the past. The key distinction is that the VC only gets one cash flow. They only get paid at exits. They can't sell their stake, or they can't extract money out of the company until they just sell their stake, usually through an IPO or when they sell the entire company. Another key feature is that when they're doing their forecasts, they're forecasting the best case, right? The home run. What happens if everything goes well? They're not splitting hairs on all the ways that a company can fail. Now, most companies will fail. Most of these startups will fail. So to account for these 2 points, that the forecasted cash flows don't include failure, but many will fail, what they do is they ramp up the discount rate. You have a very high hurdle rate to discount a very high cash flow. That's going to bring you to the expected value of the company. Again, we had this analogy with a bond. It looks a lot like the same logic we had with yield to maturity and bonds that could default. Now that we've talked about valuation a lot, we're going to talk more about higher level economics. How exactly can VCs add value to companies? We're going to revisit these Modigliani and Miller violations and see how venture capitalists can address them and move us closer to the perfect M&M world. We'll start just by talking about what VCs are doing with their time. So about 25 to 50% of the time, VCs say that they're sourcing. What this means is they're looking for the next deal. Right? There's all of these entrepreneurs out there, all of these startups. Sourcing means they're trying to find new deals to invest in. Now, everyone says that they have proprietary deal flow. Okay, what deal flow means, deal flow is all the potential deals that they see. Okay, so if you're a good VC, then you're going to make sure that you see all of those good deals, right? You don't want to see all of the kind of failures, all of the junk. You want to see the good stuff, the high quality investments, and you want to have access to it. So all the VCs say that they can do that, right? Everyone says that they have this proprietary deal flow. No one else has it. They have kind of a special network, and that allows them to find all of the good investments. They spend a lot of time looking there. Generally, VCs will have an industry focus, and that feeds into the deal flow. If you know everyone in a certain area, you have a network there, you can find the deals as they get developed. Some VCs are going to be in Massachusetts working on biopharmaceuticals. There's kind of a cluster there. Then there's obviously Silicon Valley. There's some medical technology VCs in Houston as well. So generally, there's some focus that helps them here. Then they're going to spend 15-25% of the time on kind of due diligence and negotiation. So we talked about this a little bit before. Due diligence for a VC, it's not just kind of reading a prospectus or something, right? They're actually trying to get in to the weeds of a company and to learn about it. And that also helps them with negotiation, because if they know the company and they've been consulting for the company kind of for free, then the founder is going to give them a better deal. You're going to give them a better price. The startup's going to give them a better price when the VC decides to invest, because the VC has already demonstrated that they can add value to the company. Right? So it's partially research, but kind of thinking ahead, that due diligence feeds into the negotiation and the pricing of the terms. It's also going to show up when we talk about structuring deals. The more you know about the company, the more you're going to be able to write the contract to cater to that particular company. The contracts are generally, they're not very boilerplate, right? A boilerplate contract is one you give to everyone. Every startup you give the same contract to. That's not how VC works. So they're trying to pull these different levers in a contract to solve certain Modigliani-Miller problems. Okay, but in order to do that, obviously you have to know about the company. You have to do the research, the due diligence. Once they invest, then they have portfolio companies. These are the companies that the VC has a stake in. So they'll spend about 25 to 40% of the time advising and monitoring these companies. They'll help them on operations, for example, hiring and firing decisions, strategy, organization, etc. And then 5 to 15% of the time, VCs have to raise their next fund. Okay, so VCs raise a fund from investors. They use that to invest in startups. After 3 years or so, they raise a new fund and they start the process over again. So they have to spend some time just talking to pension funds and endowments and raising new money. We said that typical VCs are not good. In order for a VC to add value to a company, in order for a VC to beat the market, to add value to the investors, they have to also be adding value to the companies. So some of what they do is provide cash, obviously. The startups need money, the VCs have it, but that's not a way to add value, right? There's lots of money out there. You're not going to be able to beat the market or improve operations just by adding cash. No one's going to pay you for doing that. One way that VCs add value is on the operational front. If the VC has a focus, has an industry focus, and they're going to know people there, so that's going to help them with personnel matters, hiring and firing, recruiting executives and board members. Also, bigger picture strategy issues and operations and networking, right? If you know everyone there, then you can introduce a startup to other partners who can help them solve problems, or customers, suppliers, etc. And of course, the next round of financing, new VC companies that could complement the company, banks, venture leasing. There's other sources of financing that the VC could introduce the startup to. If part of what the VCs can do is add value through operations, another way they can do this is through credibility. Essentially, they're resolving these M&M problems. We said that there's huge information asymmetries between investors and management. There's also potentially conflicts of interest between investors and management. The way to think about this is, suppose you just graduated. You're 22 years old. You're thinking about starting to work for a startup. A startup gives you an offer, and you think, should I take this offer, or should I go into something kind of safer? If that startup is being financed by a VC, that gives you a credible signal that the company has good prospects and that it's being run well. Okay? If you're just relying on the promise from the founder, you're not sure how reliable that is. Every founder is going to talk up their project. Everyone's going to promise you riches. It's not super credible, though. The VC is putting money on the line, and the VC is a pretty sophisticated investor. And so that's going to help. Maybe if the VC is financing this startup, now you're more likely, you're more willing to work for the startup. That's what I mean by credibility. These financing frictions here, these affect the operations of the company, right? If the management has information that no one else has, then maybe you shouldn't work for them. Maybe you shouldn't be a supplier for them. Maybe you shouldn't buy their products, right? There's all sorts of relationships that get more complicated once you introduce these information asymmetries. The VC is there to try to solve that issue. So the VC can help with all sorts of relationships with customers, suppliers, talents, you when you graduate, other financing sources. The VC is there to try to alleviate that problem. It also helps with agency problems. So as we said, that the VC is doing monitoring. Now that's also a good signal for you if you're thinking about working for the company, right? There's someone who's sophisticated there, who knows what they're doing, who's looking out for the long-term health of the company. That should give you more confidence than if it was just the founder doing everything themselves, right? Now you know there's someone who's good at this, who's also on board. Another way to do it, another way to add value is through the deal itself, through structuring the deal, again, to try to account for these issues. To highlight some of the information problems and the asymmetry problems, right, the entrepreneurs care about stuff that's different than what the VCs care about. Entrepreneurs sometimes have very kind of particular preferences for their company. We talked about this before. For entrepreneurs, the firm is their baby, right? They're very attached to it. The VCs want to earn a return, right? So you see this conflict. Sometimes there's overlap. Sometimes the entrepreneur also wants to make money. Hopefully that's the case. So you need to make sure you know where there's overlap and where there's going to be conflict. Entrepreneurs also have a lot of discretion, right? It's their company. They know everything about it. They also know what their plans are for the company. Maybe they've tried to convey some of that to the investors, but it's not easy to do. We call this moral hazard. Okay, so if you have different incentives and you have control over the company, then maybe you're going to do something different than what the investors want. Founders may try to obtain personal perks. Again, you want to look like a kind of visionary or something. So you want to get on magazine covers, you want to go to all the fancy dinners, whatever, rub elbows with the big shots. That may be what the entrepreneur wants to do. That's not necessarily what the investors want. They don't care about that unless it leads to returns. Likewise, the founder knows a lot more about their company and about their plans for the company. That creates this adverse selection problem. That means that the VC is going to be putting money in kind of blindly. And the real risk is that the bad founders, the founders who know that the company's not good, or they know that they don't want to work hard, or they know that they don't want to make money for the investors, you're worried that they're going to be the ones that take your money right away. Whereas the founders who do want to work hard, who do want to get rich, well, they don't necessarily want to share it with a VC. Okay, so that's adverse selection. The people who are going to take your money may be the ones who are kind of least willing to work hard and do what you want them to do. Entrepreneurs have what's called a low priority equity claim, right? They get paid last. Okay. They get paid after the VC gets paid. So what this means is that the entrepreneur has incentives to shift the wealth from, like the VCs, from the senior claimants, they get paid first, to themselves. One way to do that is through these non-pecuniary benefits of control. Again, this is getting on magazine covers, being talked up in the press, going to fancy dinners, not financial returns, but it's kind of personal returns. The kind of psychological attachment that founders have to their company can also lead to issues with when to sell. Right, the VC wants to exit pretty quickly. The founder may not want to do that. Right, so that's always a sticking point. When do you sell or when do you merge the company? The founder is kind of wrapped up. His identity is wrapped up in the company. That becomes a totally different process to sell his stake, his or her stake, relative to the VC. Right, the VC doesn't have those same incentives. A further complication is that the entrepreneur could just leave. Right, the VC invests in the company, and the entrepreneur could just take the clients, take the ideas, take everything that they've done, and go somewhere else, start a new company. Okay, so there's big problems, big information problems, big conflicts of interest potentially between VCs and entrepreneurs. What the contract is trying to do is to alleviate some of these issues. So you want to provide very strong incentives. The contract has to provide very strong incentives to make sure that everyone wants to do the same thing. You want the VC to get rich at the same time that the investors are getting rich, which should hopefully happen at the same time the founder is getting rich. Right? You don't want the founder with all of his discretion to get rich when the VC is not getting rich. Right? The founder has to get kind of paid last in that sense. They have to get rich only when the VC gets rich. Likewise, the VC can write the contract to screen. Okay, what screening means is that the bad founders, quote unquote bad founders, the founders who don't care about making a lot of money, you don't want them to sign the contract. You want to write a contract so that those bad founders aren't willing to sign it. The information problem means you don't know who's a good founder and who's a bad founder. But if you write the contract in such a way that only the good founders are willing to sign it, they're the ones that have kind of revealed that they're willing to work hard by signing the contract, that can address some of the information problems. Okay, that's called screening. Obviously, we can spend a whole class on all of the different contractual terms that VCs can use, but here's an outline. We're not going to discuss any more detail, but there's kind of 4 groupings of solutions, contracting solutions, to deal with the information and a agency problems. The first is the type of stock that you issue. Typically, it's going to be convertible preferred, but there's variance on that. The idea here is that with convertible preferred, for example, the VC is getting preferred stock. So they have priority over the founder. The founder gets paid after the VC, but the VC can convert it. So the VC can still get upside if the company does very well. Just to remind you, preferred stock looks like a perpetuity, essentially. But if the company does well, you don't want a perpetuity, right? You want a share of the equity that can increase in value a lot. And so VCs are going to be able to convert from preferred to common equity. And there's variance on that. There's also things called anti-dilution provisions. This means that if you raise more money down the line, if the company raises more money down the line, the initial VC is protected. Okay, and again, there's kind of very VC-friendly ways to do that with like a full ratchet. There's variance on that, but that's the idea. You want to make sure you protect the initial investor if there's new rounds of financing. With control rights, we talked about board representation. That's very, very common. You get some kind of veto. Right? You want to be able to veto bad ideas to alleviate some of these conflicts of interests. And finally, you can set the terms on the employees for the founder, for example. So if you give the founder stock, you put in some vesting period so that the founder can't cash out for 5-10 years, something like that. Again, this is to try to make sure that the founder doesn't get rich unless the company's worth a lot down the line. It's got to be worth a lot in 5 to 10 years. The founder can't cash out before then. So as you can see, there's a lot going on here. We've talked about VC financing. We've talked about it on the qualitative side. We've talked about it on the quantitative side. It looks different. The quantitative side looks different than what we've done in the past, but we're able to reconcile the two. VCs can add value by addressing these Modigliani and Miller issues. Part of the way they do that is through all of these contractual terms, right? They've got lots of different levers that they're pulling. If we had a full class, what we could do is think about how a founder could price some of these terms. Okay, so if a founder gets an offer, there's a headline value for their company. But underneath that, underneath the hood, there's all of these different terms that are worth kind of different amounts to the founder. And so we could think about trading these things off. Okay, so it's a very rich area. We just scratched the surface, but hopefully you can see how kind of the ideas in corporate finance can be translated to a area as interesting as venture capital and entrepreneurial finance.